Hi, good morning, everyone, and welcome to our webinar today. My name is Rachel Mitchell, and I'm the Director of Business Development for TorontoEntrepreneurs.ca, and I am joined by Frank Belota, Tax Partner for SBLR, and Stephanie Jindal, Senior Tax Manager for SBLR. So welcome both Frank and Stephanie. We're super excited to have you here. Our topic today is opportunities for business during the economic downturn. It's such a timely topic, as I'm sure most of you are small business owners and entrepreneurs, and this pandemic has certainly shifted the way we're doing business. And so I'm very excited about SBLR being here today and sharing their insights on just strategies and things surrounding COVID and how to move your business forward through this time period. So thanks everyone so much for joining us today. Just want to go through a few technical things before we get started. So the chat will be disabled. However, we may chat with you throughout the duration of the webinar. However, the Q&A will be open. So if you have any questions throughout the duration of the webinar, please feel free to insert them in the Q&A chat box, and we will get to them at the end of the presentation. So we'll leave about 10 or 15 minutes towards the end. We will be sharing, or SBLR will be sharing their slides at the end of the presentation. So, no need to take notes. They will send a follow-up email with those slides for you. And we do have a quick poll happening at the end as well, if you want to stick around for that. So I am going to turn it over to SBLR. They are going to discuss the financial impacts on your business during this time and strategies to move forward. So just wanted to thank SBLR first before we get into it, just for joining us and for helping our community of small business owners during this time period with this fantastic presentation that you've put together. So I will turn it over to you. And again, thanks so much for partnering with us. And I will be back for the Q&A portion of the event.
Thanks, Rachel. Good morning, everyone. Glad you guys can all join us today. So what we're going to do is we're going to speak at a high level of some of the things that small business owners should be looking at during this unnormal time, I would call it. There are some tax planning opportunities that you may not have contemplated in the past, but given the current economic situation, now might be the time. And it's all with the perspective of managing cash flow and freeing some of that cash by minimizing tax. Unfortunately, it's not just the short term that you have to consider. You have to consider down the road when we come out of this and making sure your business is positioned. What I want to start off with first is I'm going to just give you kind of a quick overview of who SBLR is and talk about some of the things that you should be doing right now in terms of managing your current situation. And then Stephanie will get into some of the tax planning ideas. So SBLR, we are a mid-sized firm, 5 partners total. We provide all the traditional accounting services in terms of your year-end financial statements and tax returns. We do things a little bit differently because we as the partners have taken the approach that we need to be actively engaged. So when you're dealing with us, we're not like your typical firms or your bigger firms where you don't have any interactions with the partners. We bring a wealth of experience and we look at it from a business perspective, not just the accounting and tax side, because our motto is the business has to drive. We can manage the tax and the accounting. The differentiator for us is we have a full-time tax department, myself, Stephanie, and 2 others. So we do everything from corporate reorganizations to due diligence on tax buys, helping you determine whether you should be leasing versus buying an asset, what are the tax advantages, CR representation, cross-border, US tax, HST representation. We do all of that, but we cater it to the owner-managed small to mid-sized business. So it's a kind of the same service that the big firms are offering for the bigger clients, but we're catering it and tailoring it to the smaller clients. One of the other services that we also do that we found that's been very useful, especially during this time, is our Cumulus online service. As you can see from the next slide here, Cumulus is SBLR's client accounting service. So basically what we do is we've developed a process where we become your back office. So a lot of the smaller startups and even some of the mid-sized firms, as entrepreneurs, you don't focus on this stuff and you may not be cost effective to have someone full-time. So depending on your needs, using various online platforms like QuickBooks, WagePoint, HubDoc, and Pluto Payment, we tailor a package specifically where we can handle your entire bookkeeping, your payroll if need be, your HST filings, all that stuff into your financial statements and tax returns. and we bundle it on a fixed fee, and we can do a payment on a monthly basis, so to manage your cash flow. So that's kind of who we are at a high level. Feel free to go to our website to get more information. However, let's talk about what you should be looking at now in terms of managing your business before we get to the tax planning ideas. So the first thing on managing your business right now is the key for all these small owners right now is taking advantage of, or utilizing, I should say, the tax relief measures. And the key ones you can see I have on screen there. And I'm going to take the assumption that you're all at least heard of these things. The Canada Emergency Wage Subsidy, that's the subsidy of 75% of your wages will be covered by the federal government. And I don't know if all of you know, but that was started out as a 16-week program. There were 3 periods. It's now been extended till roughly the end of August. And the general criteria there is you had to have experienced about a 30% drop in the same time period the year before to avail yourself of this. And the other key one was the 10% temporary wage subsidy, which was initially announced, which basically applies only to Canadian-controlled private corporations. And that caps out at a subsidy of 10% up to 25%, $25,000 per employer. The key point that I want to make here with all of these is that what a lot of people don't quite understand is that all of these are interrelated. And if you're applying for the Qs, your 10% temporary subsidy is going to reduce that. The same thing if you lay off people and they're claiming the 2000 Canada Emergency Response Benefit, that will impact an employer's claim for the other subsidies. And keep in mind that these are subsidies, so you will be required to report them on your tax return at the end of the year. So we've been working with our clients in getting these things properly set up because there are a lot of nuances, and the government has said clearly, and they've upped the ante on this, in that they will go after people who make errors, and they're looking for recovery. So as long as you're doing it legitimately and there's an error, we don't have to worry about penalties. But the concern is if you do this incorrectly and then 6-7 months, and I presume that probably early next year, they're going to start looking at these things, and you realize you make a mistake and then you got to give it back, it's certainly going to impact your cash flow. The Canada Emergency Business Account, that's been extended. That is another avenue for a lot of businesses now where you can get up to $40,000 loan, and it ends up being some write-off at the end, tax-free. What I want to caution everybody here is that the banks are administering this, and the government is supplying the funds per se, but the banks are administering it, and they're still doing your normal, typical credit rating checks. So financial statements, cash flow projections are still very important. So it's not as easy as some people think it may be, or as easy as sometimes it's been advertised by the government. One key thing here that a lot of people have sort of neglected to consider is the work sharing program. And that's been around for quite some time, available to a lot of industries. Under the COVID situation now, they've expanded it to pretty much anyone now. They've sort of streamlined a bit of the administrative paperwork required to apply for it. And while this was only available for 36 weeks, it's now available for up to 72 weeks. And the best way I can explain this for those of you that are maybe not familiar with it, I'm currently working with a client right now, and they're experiencing a potential work shortage of about 20% in the coming months. So rather than lay people off, what we've decided to do is put them on a 4-day work week, whereby the employer will pay for the 4 days, and the other 5th day, the other 20%, that will be covered by EI insurance. So that rather than putting your staff on full employment or full EI, you've now sort of shared that cost with the government. And the benefit of it is that you're retaining your labor force. You're retaining employees that maybe you don't really want to lay off at this time, because the risk is that when you need them back, they may not be available. And if you're hiring new people, there's a great cost in training and bringing them up to speed. So this is a neat program. There is some complexity. You can set it up into various groups. You can put let's say your admin group on a 3-day work week and get 2 days covered by EI. You can put your production team on a 4-day and get 1 day covered. So there's some flexibility there. So the bottom line with all of this is a way to tap into some cash flow, manage your cash flow, And if you do it correctly and manage it, it should provide you with some relief there. Now, moving on to some of the other stuff that we've been doing with our clients, and I think everyone in the small to medium size needs to consider here is planning. And it's basically estimate how long you think it will take your business to recover. And what we've stressed and what we've been working with our clients now is cash flow projections. We ourselves have started with a rolling 16-week cash flow projection. So basically we project out for 16 weeks, and every week we add one more, drop the first one. And it's all in managing, at the moment, it's all about managing your cash flow, making sure that you're covering your payroll, covering your immediate expenses. Financing, we speak to your existing banks, see what there is available in terms of relief, what concessions they're willing to make. Can you spread out those payments? This all ties into your cash flow. And these are all the things that you need to consider. And as a small business owner, you may not have been as involved in this, or you may not have spent as much time on this. This is where I strongly encourage you to speak to your advisors, to your accountants, and get some help where needed, because it is very important that you do project out properly, because that could be the what determines whether your business survives or not. Employee issues is another one that we've come across quite a bit. How do we manage that? And as I said earlier, there's the subsidies, but be careful with your layoff notices, your terminations. There are severance pays and that may be applicable or required here. The concern that a lot of employers, employment lawyers have expressed to us is that we really don't know what's going to happen in terms of whether employees start to come back and sue employers for constructive dismissal and start asking for claims. We don't know. So the idea here is get that aligned in order quickly. And as I see at the bottom there, as I say, seek professional assistance, because you don't want to spend all your time, although it's important in this area. You also have to consider what you're doing with your business in terms of maybe repositioning it so that when we start opening up, as we have, how do you get back into it? Restaurants is the key one now. It's the easiest example. Have to reinvent yourself. Most of them are now just doing takeout and delivery, where they may have not done it in the past. I have a particular client now that was in the auto industry, and what they've done is they did a lot of sewing for car manufacturers. They just got into now the need for PPE, and they're doing a lot of sewing of medical gowns and that stuff, because the demand in the car industry has dropped off. So those are things you should look at. Furthermore, review your expenses. Business travel insurance. You're not traveling, you're not doing any of that, so cut back on that. Ask your brokers to look into that. Rent is the biggest one. Unfortunately, there is some rent relief program that the government rolled out. It's basically administered through the landlords. So if you as a tenant do not have much control, so it hasn't worked that well. But speak to your landlords, because it is in their best interest to try and work something out with you, because the alternative is empty space. As we said with salaries, look for government relief. Owners and managers really need to start deferring salaries and dividends. Only take out what you need for personal living, and leave your draws in the business. I mean, even if you're allocating income to yourself, leave the money in the business. There's means of protecting it so that you're providing a secure loan back to your business, but that's another form of funding and managing your cash flow. It's all the whole concept of shareholder loans, for those of you that are familiar with that. Tax filings, I know here at SBLR, I know the deadline has been extended, but we pushed our clients strongly to try and get everything filed by the 30th so that we know exactly who's owed money, and get those in right away, get them in. If you don't know, then if you do owe, you have until September 1st, but if there's refunds owing to you, it's important to get that. Again, another source of cash flow. And I can tell you right now, for most of the personal tax returns that we have been filing for our clients, the turnaround time from CRA has been a couple of weeks at max to get those returns processed and refund checks issued. So again, a good source if you got refunds. HST credits, that's particularly of interest. If you're owed a refund there, get that in as quickly as possible. I will, though, strongly encourage you to make sure that your record keeping is in order, because that is an area that CRA will review now and into the future, and you don't want to be putting in a claim for a refund that you find out is an error, and then you got yourself another cash flow down the road because you have to repay it. And stay on top of your AR revenue and AR collections. We've been talking to our clients every day, especially your key clients, the ones that are supplying you with the most revenue. Work with them because they're probably having as much trouble as you are right now. Fix your terms, consider extending terms. And again, like I said earlier, look for new ways to deliver your services. So from a day-to-day and the current, that's what we're looking at with our clients in terms of managing it. We do sit down with them and try to figure out what relief programs they need to get involved in terms of getting some cash flow. And the big key for us is planning into the future, and that's where the cash flow projections come. Now, the opportunity that's sort of revealed itself because of this pandemic is just the current state of the economy. And that's where a lot of the tax planning ideas that were being done in the past may now make more sense, especially for some of the smaller owner-managed businesses, because there's no questioning it that under the current situation, a lot of the values of businesses have been depressed. And typically when you're doing any kind of tax planning, it's the valuations that are the areas that are looked at or that impact the planning. So now might be an opportunity, if your business has got a lower value, to look and consider some of this planning, because as your business grows and eventually down the road goes back up to the value it is, you can potentially shelter or minimize that tax on that gain. And certainly for people that are trying to transition out or sell, you want to try and keep as much money in your pocket down the road when you sell. So get in on some of these plannings. Now I'm going to turn it over to Stephanie, who's going to talk about some of these concepts at a high level. As Rachel mentioned at the beginning, we are going to give you the slide deck, so there's some more detail there, and we're free to chat with you after the presentation. So Steph, I'm going to turn it over to you.
Thanks, Frank. Okay, so as Frank mentioned, so the tax planning strategies that we're going to be addressing today could be used by high net worth individuals, privately owned corporations, and or family businesses in order to provide significant long-term tax savings by making use of the current state of the economy. So we're going to be discussing the benefits of adopting some of these common tax planning strategies considering the current market environment. Some of the areas we'll be addressing include creditor proofing techniques, the basics of estate planning, different ways to achieve income splitting with family members, capital gains planning ideas that could be beneficial to certain individuals, and methods to use any realized or unrealized losses to your benefit. And as Frank had mentioned, one of the key components to all of these strategies is the current potential lower valuation of whether it's a corporation or personal assets such as a investment portfolio, with the main benefit being to help free up cash flow, whether it's currently now or in the future, to ensure that you keep as much as possible within your pocket, which is now more important than ever. So one of the common structures that is typically set up in some cases when an operating company has begun to build up a significant amount of funds or assets that's not required for business operations is something similar to this. So what you see here is an operating corporation, which is OpCo, being owned by a new holding corporation, HoldCo, rather than having an individual or the individual owners owning the shares directly in OpCo. Due to the limited liability status of corporate entities in Canada, this structure enables the operating company to pay dividends to the holding company tax-free over time to provide the funds, to protect the funds and reduce the risk that these assets could be the subject of potential creditor claims. So if someone sues OpCo, any assets or funds now on HoldCo would be protected, and they can only sue OpCo to the extent of OpCo's legal assets. Holding companies can also be used to hold a rental property, such as potentially the property that's actually used in the business or otherwise, and things like marketable securities that can be invested in with the excess funds that were generated from OpCo. Holding companies can also assist depending on your business and family goals in your overall estate plan. And we're going to go over this further in the estate planning portion, which is the next topic. Trust can actually also be used as techniques to creditor-proof assets or funds. So in this case, an owner can transfer funds or assets to a discretionary family trust for the benefit of themselves and their family. The family members would be beneficiaries of the family trust, and the owner would be a trustee, so they would maintain control of the assets. Due to the discretionary nature of these types of family trusts, the beneficiaries don't have a right to the trust assets until the trustees, and in this case would be the original owner, decides. Therefore, if any beneficiary runs into personal creditor issues, the creditor wouldn't have a claim to any assets within the family trust until the assets are actually distributed from the trust to a beneficiary personally. So this is a great way to transfer assets to your family while still maintaining control and also protecting the assets from family law claims of the beneficiaries and any potential personal creditor issues until the time is right to distribute those assets directly to any beneficiary. During a market downturn, such as the one we're currently experiencing, businesses are at a higher risk of lawsuits and creditor claims. Assets of the operating company are accessible to creditors, therefore it'd be beneficial to set up the holdco structure in order to protect assets. Although transfers of certain assets to trust can trigger capital gain normally, with current reduced asset values, the tax impact of estate planning in this manner is minimized if completed today. Okay, so this displays two common structures of estate planning that we typically deal with, and estate planning is one of the areas we do focus on very often with owner-managed businesses. So let's start with an example of a family of 4, 2 spouses and 2 kids. So let's just say the business, which would be OPCO in this case, is currently valued at $1 million, but it's expected to grow in value over time, which is typically the goal of any business. If all the shares of the corporation are currently owned by one spouse, and they were to sell the business 10 years from now with a value of $5 million, for example, they would have to pay tax at the top personal tax rate, which is 53.53% in Ontario. So one of the goals of estate planning is to ideally utilize the lower tax rates of other family members. And in this case, the tax on the $4 million capital gain could be split up among 4 individuals, being the 2 spouses and 2 kids, at a lower overall family tax rate. And the same issue would occur if the sole shareholder still owned all of the shares on death with a value of $5 million. So if they still owned all of the shares still by themselves, they would still pay tax at that 53% rate. And this would minimize the amount of assets after tax that can be transferred to their family through the will. As mentioned, the structure can be set up with a holding company or a family trust as shown here, and still be structured in a way that the owner maintains control of the business. Family members could own shares directly in a corporation, which is the diagram on the left, or be beneficiaries of a discretionary family trust. So in this case, when assets are transferred from the owner to the family trust, the assets could include shares of a corporation. Taxpayers are deemed to dispose of all of their assets owned at death at fair market value at that time, which in many cases can create a significant amount of tax on capital gains that are accrued over time. Instead, some of this tax could be deferred onto the next generation by completing an estate freeze where the value of the business is captured today at the lower value and the growth of the business is deferred onto family members or the next generation. In the example described earlier, the freeze would happen at the $1 million value to the original owner, with the growth, which is from the 1 to 5 million, which can accrue to the entire family. Many owners benefit from implementing this estate freeze early on in the business growth stage in order to trap the value at this lower amount, allowing for more value and therefore capital gains to be deferred. And this can be done by exchanging existing common shares, which we typically call the growth shares of the business, for fixed value preferred shares, which we call the frozen shares. And then after that happens, you have family members or a family trust subscribe for new growth shares of the corporation at a nominal amount. Therefore, any future business growth from that date forward would defer to the family members while allowing the current owner, again, to retain control. This sets the owner's capital gain on death or future sale and respective tax liability to an amount that can be planned and estimated for. So another item that's essential to estate planning is the lifetime capital gains exemption, which is available to owners of private Canadian corporations that meet certain thresholds. What it means for 2020 is up to roughly $883,000 per individual of capital gains accrued on Canadian small business corporation shares may be tax-free. So for a family of four, in our example before, where the business is owned by the family rather than just the original owner, this could represent up to $945,000 in capital gains tax savings in Ontario if the business is sold at that $5 million value in the future. And this exemption amount is also indexed each year, so it increases with inflation every year. Some of the common reasons for estate planning in this manner include reducing the rate of tax paid on a sale, proactively transferring assets to beneficiary family members to avoid deemed dispositions on death at the potentially higher tax rates, also potentially reducing probate fees, which could be owing on death, thereby maximizing the after-tax value of your estate that passes on to family members. And probate fees are right now 1.5% on your entire estate value when you pass away. Protecting family assets from creditor and family law claims, as previously mentioned in the creditor proofing section, and allowing for wealth in your business to pass to family members in a tax-efficient way. The benefit of implementing an estate freeze now is that, again, the current business values may be lower than in normal times, which could be due to reduced revenues, the status of contracts being uncertain, government requirements to be closed or operate at reduced hours or capacity. And also, portfolio investment values are in many cases down as well. And because the values are down, even more upward growth can be deferred to your family. If a past estate freeze has already been completed, there is actually potential to refreeze if the value, which may make sense if the value today is actually lower than the value that you froze at before. And this allows for taxes to be spread out over more individuals at lower tax rates and the ability to bring a family trust structure into the picture at the same time. So with respect to income splitting, a similar trust structure could be set up to achieve this as well. And this goes hand in hand with the estate planning that can be done. So in this example, let's say the owner is paying tax again at the top tax rate on their investment income, which is 53%. Whereas he or she has family members that pay little or no tax as they have no or minimal income. And this could be if perhaps one spouse isn't working, someone's in school, kids are in school. The owner could loan the funds or the investments that they have personally to the new discretionary family trust to income split with these lower income earners and therefore pay less tax as an overall family unit. Interest would be owing on the loan at the CRA prescribed rate of interest, which is currently 2% and going down July 1st actually to 1%. The beneficiaries of the trust would report and pay tax on any investment income earned by the trust and allocate to them from the trust. And the lender would only pay tax on the prescribed rate of interest each year, which is the 1% that they receive from the trust on the loan. So in this example, if there was a rate of return of, let's say, 5% on a $1 million loan made by the original owner, the $50,000, which is the 5% rate of return of investment income, could be picked up at a minimal or nil tax rate, which is through the family members, with only $10,000 being the prescribed interest rate of 1%, being picked up by the original owner, instead of the owner picking up the full 5%. Therefore, the lender pays tax on $10,000 of income at their top tax rate of 53% versus paying this rate on $50,000 of taxable income. Income splitting strategies allow income that would otherwise be taxed at the top tax rate, as we saw before, to instead be taxed at a lower tax rate, which is possible if there's lower income earners in the family. But it's important to note that the prescribed rate loan strategy is necessary due to specific tax rules currently in force to mitigate the effects of income splitting between related individuals. So they want to make sure that some tax is still payable in situations like this. This prescribed interest also has to be paid to the lender, which would be the original owner, by January 30th of each year the loan is outstanding, and this is crucial. This strategy is possible with a family trust or between individuals directly. And it's important to be cautious when paying dividends in a corporate scenario to family members. So in that opco situation, to be careful when paying any dividends to family members unless they're active in the business. And this is due to some other complex tax rules, which are referred to as the new TOSI rules. So this strategy is most useful when income splitting passive investment income, such as income earned on publicly traded investments. And this is unless there's a lot of individuals in your family that are active in the business. So again, due to reduced asset values, any loans of funds or assets to family members, whether it's directly or through a trust, would attract lower capital gains tax. So anything transferred to a child, or maybe you have an older parent with a lower income bracket, would take place at market value. Therefore, if there's an accrued capital gain, this could be a taxable event. However, this strategy would enable wealth transfer to the next generation with a lower overall tax hit, compared to in the future if the assets end up increasing back in value. Again, if a trust situation is utilized, control could be retained by the original owner. Assets with inherent capital losses should be reviewed prior to any transfer, as there are special tax rules that also affect these losses and the owner's ability to claim them. So just be careful before transferring a significant amount of assets, and some maybe have losses. As noted, the CRA prescribed interest rate is set to be reduced from 2%, which is right now, to 1% effective July 1st due to lower interest rates currently in place right now. So it's a great time to implement the prescribed rate loan income splitting strategy, as this is the lowest rate. And the strategy is profitable to the family unit if the investments, again, can earn a rate of return that's higher than the 1% prescribed rate. And the loan interest rate, which would be set in stone at the 1% on the date of the loan for the life of the loan or the life of the trust, if a family trust is used. So that's another benefit in case the interest rate goes back up. Okay, so private corporations that realize capital gains increase their capital dividend account. And then again, when a capital loss is realized, this reduces their capital dividend account. So what this account is so if there's a balance in this account, meaning that there's more capital gains that have been incurred versus capital losses, it's beneficial to pay this amount out to the shareholder as a capital dividend, which is tax-free to them. So they wouldn't be, even if they're in the top tax bracket, they wouldn't be paying their top rate of tax on this. They wouldn't pay any tax, actually. And capital gain, another thing is capital gains are typically preferable over dividends or salary to corporate shareholders, as the tax rate on capital gains is 50% of the tax rate on ordinary other forms of income. Therefore, taxpayers are encouraged in certain cases to implement strategies to take funds out of the corporation as a capital gain versus dividends or salary to take advantage of this lower tax rate. So for corporations with a capital dividend account balance, it may be beneficial to pay this out tax-free prior to realizing any capital losses within the corporation. And due to reduced asset values, capital losses have become, unfortunately, more prevalent compared to in normal market conditions. And inherent capital losses won't reduce this balance. It's only when the losses are actually realized, so when something's actually sold. For corporate business owners that routinely take a large amount of funds out of the corporation, perhaps they have high personal living needs, or they have kids that they're paying for to attend school, etc., and they have to pay tax at the top rate on the corresponding dividend or salary income, it could be beneficial to determine whether a capital gain plan would work to take those funds out at the reduced effective tax rate. And the higher the income needs, the more the potential tax savings. So you could be paying tax at a rate of 26% in Ontario versus the 53%. Also keep in mind that due to potentially reduced corporation values, there could be a lower upfront tax bill compared to when market conditions get better. And also note, there has been talk that this 50% inclusion rate for capital gains could be increased in the near future, which would result in higher tax rates on the capital gains incurred. So with respect to loss planning, the tax rules allow losses incurred to be carried back 3 years and forward 20 years if it's a capital loss, and forward indefinitely for capital losses. So one loss planning idea could include in a corporate group, if there's 2 or more corporations, potentially amalgamating a company with losses into a company with profits in order to minimize the overall tax bill of the corporate group. So basically, if there's losses in LOSCO incurred, they can be offset after the amalgamation with the taxable income and the profits of the profitable companies, which we call profit co. So here's a diagram just showing this. So in this scenario, a holding company owns 2 sister companies, and one has losses and the other one has profits, and they're all under common control by one family. LOSCO and ProfitCo combine to form one newly amalgamated corporation and offset the losses with profits, reducing the overall taxable income of the corporate group and therefore the overall tax. This strategy will also depend on the business and legal reasons, again, for maintaining these separate corporations. So it might not make sense from a business standpoint if the 2 business lines need to be separated, or there's other legal reasons for having both businesses in separate entities. With losses in LOSCO of 500,000 and profits in ProfitCo of 1 million, the taxable income, if the 2 companies were amalgamated, would be 500,000 versus 1 million. And this could represent, at a corporate tax rate of 26.5% in Ontario, up to 132,000 of tax savings. So in today's environment, unfortunate losses could be higher than normal, whether it's from capital or business. And as losses are realized, they can be carried back or forward or combined with another entity in the corporate group to reduce taxes already paid or payable in the future. And this would therefore increase cash flow, which may be needed at a time like this. So for individuals, the decline in value of certain assets could be used to offset capital gains. So for example, if you have marketable securities with reduced values, these can be sold on the open market. And the resulting losses can be applied against capital gains realized in the past 3 years, creating a refund of tax that you previously paid, or the losses can be applied against future capital gains to reduce future taxes owing. Also just note that generating losses within related parties, so for example, if a spouse sells an asset to another spouse and incurs a loss, you might not be able to actually use that loss due to specific tax loss rules between related parties. So a review by an advisor is recommended prior to implementing this form of planning. Okay, so now I guess we'll turn it over to everyone for any questions that you may have.
Actually, Steph, can I just make a few comments before we take some questions?
Sure.
So I just wanted to kind of touch on a couple more things that Stephanie had mentioned there. So we've gone through this at a high level. Just want to caution everyone that your specific situation is going to determine how these ideas will work for your particular situation. And always, again, just review with your advisors. Keep in mind that what the purpose of some of this planning is really twofold. The theme there is we don't know what's going to happen a month from now, 2 months from now, when things start to pick up again. And that's why the creditor proofing becomes important, because unfortunately, right or wrong, we do anticipate that there will be creditors or lawsuits happening because people are going to want to recover there. I'm not here to pick on landlords, but there's a lot of lease and rental contracts that a lot of people are not making good on. So you kind of want to protect your interest in that manner. And to Stephanie's point, the capital gain exemption planning, where if we can get your business position now, as it grows, you can tap into that extra capital gain exemption of just over 800,000, and that's a big savings. That's roughly almost what, Steph, about 250,000 of tax savings per gain. The cautionary note there is that capital gains, as Stephanie had mentioned, are only 50% included and taxable under the current tax regime. There has been talk that it was going to go to 75 and then somehow grinding down that. And that was the anticipation that we were all waiting for to come out in the budget that would have been presented in March. But given COVID, it didn't happen. So we're now trying to sort of guess the same way we do with cash flow and kind of speculate where are things going to go from a tax regime come 2021. It doesn't have to, you don't have to be an economist, an accountant, or a rocket scientist to kind of figure out that someone's got to pay for all these relief measures. And we in the accounting and tax world are preparing ourselves in that we're going to potentially see a lot of change in terms of new taxes, increase in taxes to try and recover all this money that's been spent in the last 4 months and into the end of the year. So really, if I can just kind of summarize everything here, we're just trying to give you ideas here and to set your business up to protect it, protect the cash that you have, free up some cash, get access to cash, and get yourself set up that, you know, you're building something, you want to be able to retain as much of that value as possible, whether it's dropped in value from what it was before COVID or whatever it gets to afterwards. You want to keep as much as possible in your pocket and not get hit by the taxes, which we believe that come 2021, we're going to see some tax increases because there's no other means of getting back all this funding, all this money that's now been doled out to help us help people that are unemployed and help continue to try and stimulate the economy. So it's great to have, but at some point it's going to come back, and unfortunately it's going to be, you know, this is kind of a little bit of my political bias, typical of this government. It's not 100% friendly when it comes to small owner businesses, despite the fact that they've given all these subsidies now. We've seen what's happened in the past. They've closed a lot of the loopholes in terms of what we could have done with income splitting in the past. And as Stephanie mentioned, a lot of this, she may have thrown out the word tossy there, a whole bunch of new rules to kind of restrict it. So in my mind, we're going to be having to brace ourselves next year to potentially deal with some tax increases and or additional tax changes. So keep that in mind. Speak to your advisor, speak to a consultant. Certainly we're here to help in any way that we can. And hopefully you found this useful. Hopefully you got something out of it. And as Steph said, we'll take some questions. And as Rachel said, we're happy to share the slide deck for anyone post this. And if you got any questions, to connect with us directly. So thank you, everyone.
Great. Well, yeah, thanks so much, Frank and Stephanie. That was a fantastic, that was full of amazing information. So we all of us, I can speak for all of us, we really appreciate you taking the time to put all that together. That was phenomenal. So we do have some questions coming in, which is great. I just want to cover, I know Frank just mentioned it, but we will send the slide deck out. So I know a few of you have asked that throughout the duration of the webinar. So we will be sending that out once the webinar is finished. I think SBLR will follow up with that. So we do have some questions, so we'll dive right in just so we don't run out of time. So the first question is, can current investments be transferred to trust with the loan strategy without immediate tax?
So, I mean, this will depend on the values within your market investment portfolio. So assets with accrued gains, unfortunately, can't be transferred to a discretionary family trust without paying tax on any of those accrued capital gains. So, I mean, what we typically do in a situation like this is run through the different investments in your specific portfolio, and there's certain ones that can be transferred with maybe that they don't have a significant capital gain, and going through it that way with your broker in order to help with that tax hit. So, I mean, there's different ways to kind of deal with this, and the other thing is with losses, you might not be able to offset the losses with those capital gains just because if you're transferring the investments as is to the family trust. But I mean, if there is a buildup of cash over time just from you earning your normal salary or dividend income, instead of investing that right away personally, what we say is use these excess funds to put into the trust, because there wouldn't be any tax impact on just putting cash into the trust if you have that loan strategy set up.
And Steph, if I can add to that, because we're working on a couple of those right now. I have a client where we're working with the broker. We're just kind of purging the gains with the losses to offset, and then take the cash over, and then wait a certain period of time, and then just reinvest. But you can also do it in stages and transfer a portion of the portfolio at a time. So avoid the ones with gains, avoid the losses if you can't use them, and sell over the ones that are not going to trigger taxes to you personally. So there are strategies that can do it. It's all going to depend on your specific portfolio and what can be done with it. But there's usually a way to do it.
Okay, perfect. So what plans can you put in place to reduce tax liability when a state freeze is implemented?
Okay, so one of the main ones is the capital gains exemption. So if you are planning to potentially sell in the near future, later on in the future, what we mentioned about that $883,000 capital gains exemption, that can be spread out over 4 individuals, which will save you on the taxes instead of one individual paying the tax. So basically, if they're in the example with the $1 million company that grows to $5 million, instead of having one person have the exemption of only $883,000 and the difference of the basically $4 million be taxable in their hands, you can get 4 of those exemptions. So up to, I mean, it'll be just under $4 million that would be exempt from tax in this situation if you're able to implement this estate freeze early on enough before the business grows too much. They can utilize all of those exemptions by other family members. And another thing is, as we mentioned, is the tax on death. So instead of whether it's you selling now or when you pass away, you still have all of the shares. Instead of paying all that tax when you pass away, you are able to defer the tax through the family trust structure or other family members onto the next generation, rather than kind of paying that tax earlier on. And I mean, one other thing was, if there are active family members in your business, income splitting can be done. So, I mean, that's important to know too. Let's just say there's 2 spouses involved in the business, or maybe as your kids start to get older and they become more involved in the business, you can pay income out, whether it's as a dividend or salary.
And I was just going to add to that, Steph, because we're working on a current, and it's always great to give a live example. We're working with a current client now where we're implementing an estate freeze for all the purposes that Stephanie just mentioned. Mom and dad are looking to slow down, and they do anticipate that the value of the business will go up into the future. So as Steph said, and I can put I'll put some numbers to it. It's about it was a pre-pandemic $15 million business. It's just a traditional long-time family-owned business. It was up to 15 million. I think now, based on what we're looking at valuations, it could be down to probably 8 million. So we're looking at saying let's freeze this now. And there's a son who's active in the business right now who's going to take it over. So by doing a freeze at 8 million, the son now comes in and he's basically bought the future value for $1. So that when mom and dad's passing, they're going to be deemed to dispose of the shares for $8 million. That's assuming they haven't redeemed the shares and taken it out to live off of. So you've capped their tax on death, if you will, and you've avoided probate because we do things like secondary wills. But by bringing the son in now as a shareholder, there's the opportunity to do, and I think this is what the question was asking, there's an opportunity now to do current income splitting or reduce taxes, because that son, in my particular case, he's getting a very significant salary, over 150,000. And once you start hitting those 150, 220, you start getting into 54%, roughly 54% tax on employment income. So that's a big chunk of money. So in putting him as a shareholder, and because he's active in the business, we can now start paying a portion of that remuneration in the form of dividends, which you can get the tax down from, at the top rate, instead of paying the 54, you're down to potentially maybe what's that, 40, 46 in some cases?
Yeah. Mm-hmm.
So that is a significant savings there. And typically what we do there is that, if you're taking a salary of, 200, or if you're taking a salary more than 150, we're always looking potentially to do dividends, because we kind of say 150 is good because that lets you earn the most RSP contribution room as possible. So you get your salary, it's a good rate for the company in terms of keeping it at the small business rate in the company, but everything above that, you don't really need to take it in the form of a salary. Take it in the form of a dividend and save your 6-7 points, whatever it is there that we can save on that. So that's kind of how that estate freeze comes into play.
Okay, perfect. So this one, I don't know if I'm going to read this right, but will a loan to a family member or spouse be given, I guess it was given to purchase a property, be charged interest as interest paid by a spouse in a tax return?
Okay, so I think what they're trying to say is, can you claim that interest paid on that loan in the tax return of the recipient of the loan? And the answer is yes. So in the example we had where the interest payable was $10,000 by the family member, so let's just say the spouse, because they're paying $10,000 to the original owner, they can deduct that $10,000 interest in their tax return, and then the original owner picks up $10,000 of interest income. So, I mean, it's pretty much an offset in the way that one person picks up $10,000, but the other person still gets to deduct it. So you don't just lose that deduction.
Okay, perfect. And how long does it take to implement a reorg plan?
That all depends on the value. And I think, Rachel, you and I were talking about something similar to that when we were going through this presentation. I'm working on one now where I've just completed it today, and we started the process about a year ago. So it does take time. And the reason it takes time is because you have a number of individuals that have to get involved. Yourselves, obviously, us as advisors. There is a lawyer required to document the legal documents because there will be changes in shares. And depending on how comfortable you are in determining a value to your company, we may or may not need a evaluator. So these things, as I said at the top there, these are good planning strategies that a lot of people and a lot of companies have taken advantage of, certainly some of the bigger companies. But the goal here, it's available to every size business, providing the numbers make sense. And that's where we kind of merge that to let you know whether, yeah, this is a good idea, a cost analysis, because you don't want to be spending more than you're going to save. And that's what we kind of bring to the table. So, the shortest, if you really get everybody in play, we've done them and gotten them all completed in as short as probably 2 to 3 months, but they could drag out depending on how many people are involved, because sometimes you have an estate where you have mom and dad and you have 3-4 siblings and who's coming into the business. So on average, I mean, we could get it done in 3 months. On average, you're probably looking at about 4 to 5 months to get this all done.
And I mean, what typically happens is it might start with us kind of putting in place a plan, going through you with your overall family goals and objectives, and just reviewing your whole structure and your where you kind of want to see this going. And then a lot of times, if for example, if an investment portfolio is involved, we might have to involve the broker, and then we have to put everything and send instructions to the lawyer. So it also depends on everyone kind of being in the mix. And then, as Frank mentioned, this, if you have an evaluator that adds a fourth person, that could come into play. So it does depend on kind of all the parties involved as well, and of course yourself, and if it's the right time to do this.
Okay, perfect. I think we have time for one or two more questions. So what's been your experience when dealing with the banks to provide access to loans?
So that's a good question. In addition to all those subsidies on the wage side, the government has released a lot of money in terms of working with the Business Development Corporation Bank, EDC, and the major financial institutions to free up millions of dollars of loans or cash available to make loans. In addition to there's a lot of co-sharing arrangements. The application process, as I mentioned off the top, it seems to have been oversimplified. It all depends on the bank you're dealing with. We have come into contact with 3 of the big banks that we're working with right now and our clients, and it varies, but I can tell you the ability to repay or make payments on the mortgage and interest payments, that's still a focus of the banks. The banks are not as easily giving up money as it seems that the government is pushing them or asking them to do it. So we're struggling in that your financial statements, your cash flow projections, they're all asking for that ability to pay analysis. So you're really going to have to make sure that your bookkeeping, your accounting records are in order. And they want to see where the profit is, and more so where the cash flow is to service that debt. And a lot of banks now are pushing for, not the simple compilation or notice to reader statements. They want some kind of assurance that those statements are accurate. I'm not suggesting that they want audits, because we managed to convince them that they don't really need audit, but they do want some kind of review engagements where they got a CPA firm rubber stamping it that they've looked at it. So it's all going to depend on the bank, but I can tell you that they're not giving out the money as freely as it would seem that they are.
Okay, perfect. What is an ideal company, business, client to implement the planning that you suggest?
Yeah, go ahead.
Agnes, so the ideal client right now would be a company that is looking to transition to the next generation, okay? Looking to minimize its tax on exit down the road. A company that's looking to tap into maybe the income splitting scenario that we just mentioned with the example of the son. I can tell you, you have to have a certain threshold of revenue or income being generated for some of this planning to make sense. I mean, if you're if you're in that $1 million, $2 million, $3 million type revenue company, some of this planning may not be for you. It's not to say that none of it is, but ideally, once you've reached for us, we look at it, once you've reached the point where your business is worth more than your capital gains exemption. So anything over $800,000 plus there, you've now maxed out on your ability to cash out tax-free. The question is, is there a spouse? Are there siblings are there kids that we can bring in so that you can grow it more and then get that more out? So it's all going to depend on the individual client. And then there's some industries where they're just not sellable businesses that you wouldn't even implement this.
And then with respect to the income splitting, it makes sense depending on the tax rate that you're in and the tax rates of your family members. So even if it doesn't make sense to do some of this planning within the corporate structure, there could still be potential with kind of just setting up potentially family trust or just between individuals and just saving on the overall tax with your family, if it makes sense.
That's perfect. That's amazing. So we're almost at 12. So just wanted to, again, thank everyone today for attending and thank SBLR for your amazing presentation. Like I took a million notes and learned a lot from everything that you said. So just really appreciate that. I know our attendees obviously appreciated it as well. So is there somewhere that they can go to contact you for more information, or if they want to reach out to you, do you have some contact information?
Yeah,
I think you
I
had some
think
on the
we'll
previous
put them on
slide.
yeah, I'll leave it, put it back on the last slide for a second.
And I know you'll be
Um,
following up too,
with
but
some
just
information, yeah, and then we'll send an email also to everyone that participated with the slide deck and our contact information as well.
amazing. Well, thanks everyone for participating, and thanks again to SBLR. You guys have been amazing, and we hope everyone has a great rest of the day. So thanks so much for tuning in.
Thank you,
Thanks, Rachel,
everyone.
and thanks everyone for attending.